Good morning and welcome to the Killik Co market update. It's been a very turbulent week for markets and we have seen fairly significant falls across major global markets. So let's have a look at here at this chart of the S&P 500 over the last 5 years. As you can see, there is a fairly steep drop off towards the end and most other developed markets are showing a very similar pattern. So what's happening here? Well, we think this current market fall feels fairly similar to the market fall we had back in the first quarter of this year. Now that market fall was caused by some unexpectedly strong wage growth data from the US, which caused investors to be concerned that that wage growth data would feed through to higher prices, i.e. inflation, and then the Federal Reserve would raise interest rates in order to bring down that inflation. That caused concern that it would become more expensive for companies to borrow money, and therefore we had a fairly sharp market sell-off, with global markets falling about 10%. But as you can see by the chart, they did recover fairly quickly, and the market did resume its pattern of growth. So what's happening this time around? Well, last week, Amazon, which is a major employer in the US, the company announced it would be raising its minimum wage for all workers to $15 per hour. And it's likely that other global companies will follow suit. So that's made investors think once more that wage growth in the US is going to rise. And again, they're thinking that will feed through to higher rates of inflation and therefore higher rates of interest. And if we think about the Federal Reserve over the last few months or even the last few years, the Federal Reserve has repeatedly said that the reason they haven't been raising interest rates more quickly is that wage growth in the US has been fairly limited. And we can see that on this chart here. So this shows wage growth in the US over the last 20 years. And as you can see, it did fall quite heavily during the financial crisis. And since then, it hasn't really recovered. So that's what the Fed has been keeping an eye on. And that's why they haven't been raising rates more quickly. But if those numbers start to pick up, then it's possible we could see a slightly steeper rise in interest rates. So I think that's why the market has sold off over the last week or so. But it's important to bear in mind that the Federal Reserve still plans to raise rates slowly and gradually over the next few years, and that their long-term interest rate target at the moment is still below 4%. So that's still relatively low in comparison to where interest rates have been in the past. And still on the subject of this week's market weakness, I think it's important to look at which areas of the market have been the worst hit and which have been relatively resilient. So let's have a look at another chart. This is the S&P 500 over the last year, and this shows the percentage change in the index. The pink line in the middle shows the regular S&P 500. The purple line at the top shows the growth constituents of the S&P 500. So that's the companies that demonstrate higher levels of sales growth and higher momentum. So for example, Amazon, Apple, Microsoft, those sorts of companies, they're the ones that have performed relatively well during the current bull market. And then going back to the chart, the green line at the bottom is the financial constituents of the S&P 500. So as you can see, they have not performed badly over the last year, but they have not performed anywhere near as well as those growth constituents. And looking at where all these different sectors have sold off over the last week, as you can see, the growth constituents have sold off much more than the wider S&P and also compared to the financial constituents. So for us, this just really shows that it's important to remain diversified. And had you had your portfolio fully invested in those growth sectors, your portfolio probably would have been hit quite hard this week. So it's important to make sure you're diversified across different sectors of the market. And finally, investors continue to focus on the developing situation in Italy. We recently had the election of a populist coalition, and people are concerned that this coalition will try and raise Italy's spending to the extent that it will raise Italy's debt level to an unsustainable level. Now, at the moment, Italy has one of the highest levels of debt in Europe. It's equivalent to about 132% of the country's GDP. Now, this populist coalition wants to allow Italians to retire at 62 rather than 67. They want to lower taxes, and they want to pay income to the unemployed. These are very expensive policies and they would necessitate an increase in borrowing. Many investors are worried that this would make Italy's borrowing unsustainable. And because of that, we have seen over the last couple of weeks an increase in Italy's 10-year government bond yield. So that suggests investors are selling off government bonds because they're worried about Italy's ability to pay off its debts. So as you can see over the last 2 weeks, there has been quite a notable increase in that 10-year yield. Now, moving on to the week ahead, clearly we will be watching the market very closely following the recent turbulence, but it's also the start of another earnings season, so we do have lots of companies reporting next week. And to name a few that we'll be looking out for, we've got Total, the oil company, Goldman Sachs, the US bank, and also Intercontinental Hotels Group. So that's it from us. Have a great weekend, and we'll see you next Friday.